who until very recently was the chairman of the Council of Economic Advisors under President Obama, is now moved to the Kennedy School, but fortunately is still in Washington as a non-resident senior fellow here. We will then have Larry Summers, who truly needs no introduction, former president of Harvard University, former US Treasury Secretary, and now university professor at Harvard. And we will have, importantly, also Anna Stansbury, Larry's co-author, a brilliant PhD candidate who will probably increasingly overshadow certainly, you know, the people she has worked for as RAs and possibly even her co-authors at some stage. And last not least, we have Jana Reams, who is an economist and a partner at the McKinsey Global Institute based in San Francisco, where she worries particularly about productivity, science, technology, innovation type issues. Jason, you're going to start? Great.
So thank you very much, Jeremy, for just the great organization of this conference, Robert for inspiring it, Adam for continuing to have me at Peterson, and in tribute to that, using your format for the slides here today. The mandate for this is we were all asked to think about the consequences of low productivity growth for different areas. And I found it pretty much impossible to do that for my topic because in many ways productivity and inequality are very much related to each other. And so to just ask the question of an exogenous change in one, which has exogenously changed a lot in the last several decades, what will the implication for the other be, is a question I have a hard time thinking about. So change this a little bit to asking the question of whether they have a common cause. And this is based on work that I've been doing with Peter Orszag, and I'll go the right direction. So I want to talk a little about the question, talk about some of the key facts that we would want any explanation to address, talk about some of the evidence for reduced dynamism, which will be an important part of the story, some of the evidence for reduced competition, another part of the story, and then what this has to do with possible explanations for all of this. So starting first with the question, as is famously well known to everyone, but worth staring at for another moment, we've simultaneously seen two things happen. The first is productivity growth has slowed down. In the United States, it was 2.8% a year. Now, since 1973, it's been 1.8% a year, and we're supposed to assume something like that going forward. And second, during that first period of rapid productivity growth, you saw, if anything, a slight diminishment of inequality in the United States as the share for the top 90% went up and the top 1% went down, whereas this period of slow productivity growth has coincided with a large increase in inequality. And this is just the story for the United States, but broadly across the advanced economies, you'd see a similar type of story, that the period of slowing productivity growth has coincided with a period of increased inequality. Sorry, I keep going backwards. The traditional explanation is rooted in skill-biased technological change, and it says that it would increase inequality when you have a higher return to skills, raises the premium for skilled workers. There's some tension between that and lower productivity growth. That was rectified in these models largely by adding in education. So you had the race between education and technology. But as Larry Michel and Josh Bivens and others in the room have documented, that explanation is having an increasing problem over the last decade. And a certain amount of it also just depends on what you assume in terms of certain underlying trends in inequality. So that explanation, if anything, goes the opposite direction. Second, there's a lot of emphasis on inequality harming growth. And that could potentially, unlike the traditional explanation, explain the coinciding of high levels of inequality and low levels of growth. There's certainly some macro evidence for that and some micro channels. The last time I was here at Peterson on Rethinking Macro about a month ago, we talked a lot about that, and I shared some of my skepticism about some of the empirical research, but more importantly, the magnitudes don't come anywhere close. If you put in these types of changes in inequality, even into the models you look at, you wouldn't predict anything like this magnitude of a productivity slowdown. And so what I wanted to explore is the idea that these two have a common cause, and in particular, that reduced dynamism and reduced competition can both cause lower productivity and cause lower inequality. And I should say at the outset, what I'm trying to do is see how far this hypothesis takes you. I don't think this explains everything about inequality. I don't think this explains everything about the productivity slowdown. But the question is whether this explains a part, and potentially even an important part, is important both substantively for trying to explain these phenomenon, but also policy-wise, because it opens up the opportunity for a whole new set of policies that, one, have the potential to have benefits in both dimensions for productivity and inequality, and two, opens up a richer set of policies, including in things like the product market space that might matter in labor markets as well. Since the paper Peter Orszag and I first did on this topic, there has been, or some of this is in coinciding with it, there's been a lot of research on this, and broadly speaking, I'd say it's been more corroborative than not, but it's a variety. So you have papers by Gutierrez and Philippon on linking investment at the industry level to the degree of concentration. You have a job market paper from Barkai from the University of Chicago looking at concentration, explaining the decline of the labor shares. Autor et al. Have something that links concentration to large declines in the labor share of income, although they have an alternative interpretation of what that is that centers around sorting. So there's a growing literature on this question, but we're still at an early stage on it, and I think it's an exciting, important, and I think it will still be an open question when I'm done talking today. So I want to talk now about what we're trying to go one step deeper than just productivity and inequality and get at some of the second level stylized facts that one's trying to bring into this. The first is that productivity growth has slowed, but that some firms are doing considerably better than other firms. That's going to be an important part of the story here in the link. And moreover, the OECD story, which they presented in this room a few years ago, and I had a chance to comment on, is that the diffusion to the lowest performing firms has fallen over time. And in inequality, drilling down a little bit further, that, in addition to inequality has increased, the fact is that largely that's an inequality within labor income, which is a point that links to the next paper, the Stensbury-Summers paper that we're going to hear, that capital income matters but doesn't matter as much in the labor capital share being the disconnect between productivity and average compensation also doesn't matter nearly as much as this inequality within labor income. And then if you look at what's going on within labor income, a lot of that is going on, or almost all of that is going on between firms and not within firms. To put some of those facts on the screen in a little bit more detail, more firms have much higher rates of return. The Treasury Department, in a paper that is still up on the website, has documented that the component of returns that are supernormal has risen over time relative to the normal returns. This just looks at the S&P 500. This is something that Peter and I got from McKinsey, which looks at the rate of return of different firms, excluding goodwill at different percentiles. Goodwill is obviously an important part of the story, and that's what those returns at the 90th percentile are to, and it compresses it quite a bit. But it used to be more like a 4-to-1, and now it's more like a 10 or 15-to-1 ratio from the 10th percentile to the 90th percentile. So you have this enormous dispersion in rates of return with a small number of really super successful firms and a bunch of others lagging behind. The OECD has documented this reduction in the transmission of productivity. I think this is intriguing. I think it's helped change the way people think about things. I'd feel a lot happier if we had data going back before 2001 and had some sense about what the relationship was. Is it always been the case that frontier firms are growing faster than firms that are trying to catch up to them, or is this something really new and unique now? But the disparity is really quite striking and can help rationalize also why you'll read in the newspaper stories about these amazing companies doing amazing things. You'll look at the product, which is the red firms there. You'll look in the productivity data. You don't see the productivity data being so great, and that's because that's more of an average of the red and the blue, or at least that's part of what's going on with that disconnect. The share of income, as I said, you've seen the black line is the share of income going to the top 1%. You've seen an increase in both the share of labor income and the share of capital income for the top 1%, but the majority of the increase that we've seen has been because capital income has increased. And it depends where you're looking. If you're looking at the top 10%, it's about 80% of the increase in inequality is in labor income. For the top 1%, it's a little bit lower than that. The top 1/10 of 1%, there you want to start talking more about capital income. And then that final stylized fact in terms of inequality is sort of amazing result that really first struck us from Song et al., that if you look at the difference in wages within firms, this is a CEO of a company versus a worker in her company, there's basically been no increase in the dispersion within firms, that CEO versus the worker within the firm. If you look at everyone in a successful high-paid firm and compare them on average to everyone in a lower-paid firm, you see this huge widening of inequality. And so almost all of this is between firms, not within firms. So trying to come up with a story that makes sense of these sets of stylized facts rests on two sets of things. One is evidence for reduced dynamism in the economy, and there's an awful lot of it. Pretty much every measure that we know of shows this, and just to show a subset of them, one is the entry rate of firms, which has been declining pretty consistently as far as we can measure it. The exit rate has stayed about constant, and so now the net of the two of those is about the same. The result of that is that young firms are an increasingly small part of the economy, are an even lower share of total employment. So you have larger firms, older firms that are increasingly predominating. You see that decline in fluidity in labor markets as well. This shows it from the firm side. Their job creation and their job destruction rates have gone down. You can also see this from the worker side. The odds that you switch between industries, switch between occupations, just leave any job, make an E to E transition to move to another job, and as you see in the next chart, also moving within states, moving within counties, moving between counties, all of those have been declining as well. So the question that we have now so far is we have these larger returns in certain firms, either to workers in those firms or to investors in those firms. In perfect competition, those should get competed away, and you wouldn't see these differences between firms, or if you did, it would 100% reflect sorting, and you wouldn't see these persistent differences in rates of return either. So the question is, why could you see the persistence of these? And one would be that we think that there might be reduced competition in the economy, and that would be a story that would be consistent with this. And competition is a hard thing to measure. People have gone at it a lot of different ways. One is an observation that Larry and others have made, that you see safe rates of return have been continuously falling. The return to all private capital has, if anything, risen, And so the premium on the risky rate of return has gone up. At the same time that the rate of return to capital has gone up, the share of investment in the economy has generally been trending down. That's consistent with what you see with a monopolist, which has higher prices and lower quantities. In looking at the micro evidence, if you break that down, and I don't have this for you, by industry, you see industries that have had the largest markups have been the industries that have seen the largest increase in their markups, the largest declines in their investment. When I was at CEA, we did this. This is not, you wouldn't bring an antitrust case based on the share of the top 50 firms in a very broadly defined market. But if you drill down and go down to the 800 different industry level, you see increased concentration in most of those sectors as well. And there's a range of micro evidence and micro studies of most of the at least domestic non-traded parts of the economy, which is 87% of the US economy, that you see increased concentration in financial services, agriculture, hospitals, wireless, railroads, are some of the sectors that there's pretty good micro evidence on. So the last part of this is this question of why we've seen this increased concentration. And in general, you can think of two types of stories for it. One is it reflects something, natural monopolies and some aspect of technology that would have implications for policy, because we worry that natural monopolies can be inefficient in the way they set their prices and quantities, but it's not quite the same thing as if we directly caused it. So the other question is whether this is something that policy, to some degree, helped deliberately create and cause. The second one is even more straightforward, because it would say that concentration is a byproduct of a distorted set of policies, and is sort of presumptively not efficient and something you'd want to address. Well, in terms of the change in policies, it's hard to measure the way antitrust has been done over time, but this was Kwaka at a book he had from MIT Press about 2 years ago, and looked just at the FTC, and you see in the FTC, it's pretty amazing that if you look at mergers that go from 8 to 7, for example, they used to investigate those, they stopped. 5 to 4, 6 to 5, they used to look at those. Even 8 to 7, they used to look at, and they've basically stopped looking at mergers in almost all of those categories and have even reduced the amount they're looking at some other ones. So the bar on antitrust has shifted a lot as law and economics literature expanded the set of ways in which one understands that there can be, or argued that there can be competition where you wouldn't otherwise see it. A second, which is more in the natural category than something policymakers chose or did, is the very substantial network externalities to the tech companies where you benefit from everyone being on the same Facebook. You don't want 13 different Facebooks. You want just one Facebook. And the answer to, if you think there's a competition problem with Facebook, probably isn't going to be to break it up and force you to separate you painfully from all your friends, but is going to be something else. Common ownership has grown. There's a really intriguing literature on this, that basically you look at banks, airlines throughout our economy, the one level up owners, the people owning the equities, are all Vanguard, State Street, and BlackRock. And there's both a set of micro evidence, but also even just listening to the earnings calls and hearing them talk about how you don't want to vigorously compete too much because you'll drive down prices for the whole industry, which might be advice that would make sense if you owned the whole airline industry, that wouldn't necessarily make sense if you owned just a single airline. And then last, and this is part of the dynamism story, is you've seen a large increase in land use restrictions. Some of that is evidenced by the construction costs versus house price costs, which used to move more closely in tandem and have enormously separated from each other. Another is the increase in occupational licensing, and something we documented at CEA was if you had a license, you were much less likely to move across states than within states, in a way that people who didn't have licensed occupations didn't have that difference in their mobility. So would summarize all of this by saying, I think partly because of some policy choices we have made that have actively reduced competition, increased barriers to workers moving, to firms starting, to acquiring other firms, in part because of natural evolution in the economy, like network externalities, you're able to have these more persistent differences in productivity across firms at the same time that you don't have all of the benefits that competition and entry has for innovation. That allows some of those firms to pay their workers more, something that has been documented since Larry's paper with Alan Kruger on the topic on inter-industry wage differential. So it allows some to pay their workers more and to do it persistently in a way that is harder to compete away over time because of some of these restrictions on moving between places, moving between jobs. And all of this opens up an opportunity for at least part of an economic agenda to center around how to foster competition, which might be narrowly antitrust, but also more broadly, the things that would reduce the types of barriers that people and businesses face, so that you can have both more innovation potentially and do it while reducing inequality. Thank you.
Let me first say how glad Anna and I are to be here. This is not a moment in our national life when the quality of our economic discourse is at a maximum, and at a moment when astrology is running high. It is a privilege to be with a group of astronomers. And I think the Peterson Institute is one of a relatively limited number of institutions that remain centers of rational thought in an increasingly madding world. And that's a tribute to Adam and Jeremy and the traditions that Fred started and many others. And I am glad to be part of it. Here's what we're going to do. I am going to motivate what the thinking was behind Anna and my paper and show a little bit, very little bit of data. And then Anna is going to talk through the various statistical results. And then I'm going to draw some conclusions. All of that was what we planned. But in addition to that, I'm going to offer some observations on the extent to which monopoly power is or is not relevant to our conclusions in light of what Jason has said. Since Jason just said it, those remarks of mine, we will not hold Anna responsible for. So the starting point for our analysis is a graph that has become a bit of an economic and political cliche that I suppose has been best publicized and promoted by Larry Michel and Josh Bivens from the EPI, which shows you that after a 30-year period when wages and productivity moved together, that on the measures we have with all their problems, Productivity seems to have continued to rise, albeit slower than it did before, but wages have largely flattened out for median workers. We look at the data for median workers, and because that data only goes back to 1973, the data for production and non-supervisory average compensation. And there are two views broadly that one can take from that. And of course, as is always true, people studying things distinguish between two sharp views, but truth lies along a continuum. One view, which we label the linkage, the delinkage view, is the one that we interpreted Michel and Bivens as taking, though they probably took it in slightly less stark form, and that is, look at the graph. Productivity growth continued, wages didn't. It follows that productivity growth doesn't have much to do with wages. And so yes, if you care about the GDP of your country, it's important to have high productivity growth. Yes, if you care about how large an army you can field, how many bombers you can buy, it's important to have large productivity growth. But it doesn't seem like productivity growth translates into higher wages to an important extent. And so if you care about wages, priority has to attach to something else, and something that is distributional. And that is the view that has been at least close to the view that's been stated by a number of observers, and views in that direction are implicit in the wider spread idea that the focus of economic policy needs to shift from growth to equity. Of course, while it's a cliche that if two variables are correlated, that does not imply that they are causal. It's a parallel proposition that if two variables are not perfectly correlated, that does not imply that they are not causally related. And so an alternative view is that productivity growth is still ceteris paribus related to wage growth, but ceteris has not been paribus. Other things have changed, and a set of things have changed between 1973 and the present that have been separate from what has happened to productivity growth and have had the effect of depressing wages. A reduction in labor's bargaining power might be an example of such a thing. Conceivably, broad trends in the competitive landscape might be such a thing. Well, if you only compare 2 points, the 48 to 73 period, with the post-73 period, you have very little prospect of distinguishing between these two views of the process. The motivating idea behind our paper is that productivity growth has had significantly more low-frequency fluctuation than is suggested by the idea that it was fast from 1948 to 1973 and slow thereafter. And so by looking at the low-frequency co-movement between productivity growth and wages, one can learn something about which of these two hypotheses is true. If low-frequency movements in productivity growth translate closely into wage growth, that would tend to support the linkage hypothesis. If they had very little impact on wage growth, that would support the delinkage hypothesis. And that was essentially the original motivation for our paper. It occurred to us some time after beginning the research, that the results shed light on another idea, and that is there's been much discussion of inequality in terms of the processes of technological change. Some people say that the demand for labor is inelastic, and there's been a lot of labor augmenting technological change. And so there's been this abundance of labor, and demand is inelastic, so the relative price of labor has fallen a great deal. Other people say demand is very elastic, and there's been an abundance of capital, and that has led to a reduction in labor's share. If any hypothesis of that kind was the case, one would expect that periods with differing amounts of productivity growth would see differing amounts of these corresponding trends with respect to inequality. And so it's those propositions that we are seeking to test in this paper. And I increasingly, as I age, believe that anything that's not relatively clear from a figure isn't necessarily proven by a complicated regression equation. And so we have plotted here the 3-year moving averages of productivity growth and 3-year moving averages of wage growth on 2 measures. And we'll have a chance to look in just a second at statistical examination of these results. But our reading is that you would not want to leap to the delinkage view on the basis of this evidence, that there was a tendency for fluctuations in productivity growth to translate into fluctuations in wage growth. Anna will pick up the story here.
Thanks. So, as you can see from here, we can have a natural empirical test for the propositions Larry's laid out. If we run a regression of the change in log of compensation under our various measures on the change in log of productivity, we would expect the estimated coefficient beta to be closer to 0 under the delinkage view and closer to 1 under the linkage view. We take this to the data in a variety of different specifications, and you can see all of them in our paper. I'll talk through a few of our main ones here. We look at 3 different measures for compensation, the 2 measures that Larry laid out of the typical worker, the median compensation and compensation of average production and non-supervisory workers, who make up about 80% of private sector employment. And we also look at mean compensation for the total economy as another benchmark. It's not immediately clear over what time horizon you'd expect productivity to translate into workers' pay, if indeed it still does. And so we test it over a variety of time horizons as well. We look at a 1-year annual change contemporaneous horizon, moving averages from 2 years to 5 years in bandwidth, and distributed lag specifications with lags of productivity growth going back up to 4 years. And finally, because you might expect the labor market conditions and the position in the business cycle to affect the degree to which and the speed at which firms translate productivity growth through to their workers' pay, we control for the change in unemployment rate to proxy that. So let's look at some results. Now, first we're going to look at the whole post-war period. I'll just give a moment of how to interpret these graphs. Every point with a number by it is the coefficient estimate from one particular specification of our regression. So for example, the interpretation of the very top line you can see is that in that specification, a 1 percentage point increase in productivity growth was associated with a 0.7 percentage point increase in the rate of compensation growth for the average worker over 1948 to 2015. There's a clear set of takeaways from these different regression specifications, which is that almost all of them are strongly significantly different from 0. The bars you can see around each dot are the 95% confidence intervals in our regression. And that almost none of them are significantly different from 1. And in fact, the point estimates are very close to 1. For the average compensation in the top chart, you can see there between about 0.7 and 1.2 in most specifications. And for production and non-supervisory compensation in the bottom chart, the range is a little bit wider, but the majority of estimates remain between about 0.7 and 1. So you may say this provides some initial support for the idea that there has been linkage over the whole post-war period. But what we saw was not a question of whether there's been delinkage over the whole period, but really whether that delinkage has started in about 1973. So looking at the median worker, we can only go back to 1973 anyway because of the data. You can see the picture doesn't look that different. The specifications are noisier, the standard errors are wider, but in almost all the specifications still, the coefficient estimate is significantly different from 0, is not significantly different from 1, and again is relatively close to 1. The point estimates mostly lying in the 2/3 to 1 range. So given this, we ask, it looks like there was linkage for the median worker in the post-1973 period. Does that mean that the relationship broke down pre- and post-1973? We can't look at that for the median worker, but we can look at that for the production and non-supervisory worker compensation. Here you can see the results broken down by 1973. The top chart is pre-1973, the bottom chart is post-1973. And as you might have noticed, we've removed the dashed lines here, which are the distributed lag specifications, just for ease of viewing, so you don't have to look at so many lines. But all the results for those are qualitatively similar and are in our paper. What this shows is opposite to what you would expect in many ways. The relationship before 1973 is less obviously strong than the relationship after 1973, and the coefficient estimates are somewhat smaller. The production non-supervisory compensation coefficient estimates, I would note, are mostly significantly different from 1 in the post-1973 period, but are still relatively large. They're between about 0.5 and 0.7 on average. So taking these sets of estimates in hand, the general picture we've painted is one where there isn't much evidence for the delinkage hypothesis. That is, a 1 percentage point increase in the productivity growth rate since 1973 appears to have been associated with about a 2/3 to 1 percentage point increase in the rate of median worker compensation growth, and about a 0.5 to 3/4 of a percentage point increase in the rate of production and non-supervisory worker compensation growth. How does it look for the rest of the compensation distribution? Now, unfortunately, we don't have data on compensation by deciles for every year in this period. So we've looked at wage data instead from the Economic Policy Institute. This doesn't include any of the non-wage benefits that workers might receive. That relationship estimated is quite noisy for many of the deciles, and what you see is that it's really only for the 20th, 50th, and 60th percentiles that we can see a strong, large, and significantly different from 0 relationship occurring. We have a reason to believe that these are underestimates. If you look at the BLS data over the longer horizons, which show us compensation growth versus just wage growth over time, particularly for the middle of the distribution, compensation growth has been consistently faster than wage growth. That is, non-wage benefits have been growing at a more rapid rate than just wages. And confirming that, you can see the point estimate for the 50th percentile in light blue here is 0.7. If you look at median compensation in our previous regression 2 slides ago, the coefficient estimate was 0.9. So another suggestion that these coefficients, at least for the middle of the wage distribution, are probably underestimates. As we heard in a session earlier in the day, of course, the US isn't the only country that's seen this delinkage. So we take our method and apply it only to average compensation for a number of other advanced economies. And we see some delinkage and some linkage. So Canada, France, and West Germany pre-reunification look a bit like the US. The coefficient estimates are strongly, significantly different from 0 and close to 1. Germany post-reunification, Italy, and Japan are a lot less obvious, and we have some speculative ideas as to why that is in our paper. But on the whole, you can see that the picture we've presented suggests some pretty strong co-movement between productivity and compensation, even in that period where in this graph, it looks like they've rapidly diverged. Mitchell and Bivens, among others, have broken down this divergence into 3 different wedges. And as Larry mentioned, those parts of the wedges that are to do with inequality, the falling labor share and the rising mean-median compensation ratio, many of the explanations proposed for those wedges have been to do with technological progress, whether that's automation, whether that's skill-biased technological change, decline in the relative price of investment goods. And so we can apply our previous methods to test those stories. That is, if greater technological progress implies faster productivity growth, then you'd expect the labor share to fall more quickly in periods where there's faster productivity growth, and you'd expect mean to median compensation inequality to rise more quickly in periods where there's faster productivity growth. Just taking a rough pass, you can see that if we break down the post-war period into the 4 sort of productivity eras, the 2 faster periods and the 2 productivity slowdowns, that doesn't seem to be the case. The labor share actually fell more quickly in the 2 slowdowns between 1973 and 96 and 2003 and 2015, or present, and the mean-median ratio grew more quickly in those periods than in the periods of productivity boom. And in addition, our regression results confirm this to some extent. So when you regress changes in log of the labor share on the change in log of productivity, you find no significant relationship. We've shown you here 1973 to 2015, but it's the same if you look over the whole post-war period or over more recent periods as well. The standard errors are large, and so you might say, well, don't reject it out of hand. The coefficient estimates are negative, which is what you would expect. But actually, if you take those negative coefficient estimates and you apply them to the rate of productivity growth that we've seen since about 2000, you find that they really can't go very far in explaining the degree to which the labor share has fallen in the US over this period. And if anything, the evidence we find on the mean-median compensation ratio is starker. That is, there's no significant relationship between changes in mean-median compensation inequality and changes in productivity. And the coefficient estimates are very close to 0, and in fact are the wrong sign, as what you would expect. They're negative, and if you would expect technological change via productivity growth to increase inequality, they should be positive. So overall, what these suggest to us is that if we're looking for the driving factors behind that divergence in productivity and compensation, we should be looking at factors that are not associated with, that are orthogonal to the rate of productivity growth, because there's very little evidence that something associated with productivity growth has been causing those divergences and that stagnation. And now I will pass over to Larry to wrap up.
Thanks, Anna. I might just mention to the people in the room who are in my age range that I learned a number of things in the course of writing this paper. One of them is that a table with regression results is kind of like a landline in your house. It's sort of something you do if you're kind of ancient. And that this mode of presentation with the little line showing the confidence intervals and the figures is what we do if we're kind of 21st century people. When I first saw that Anna had done this, I thought it was kind of interesting and clever, and it was all sort of new to me. And then I saw 2 or 3 other papers that had been written by young economists and graduate students, and they had done it as well. And I asked, and someone politely informed me that if I was looking for old-fashioned regression tables, it was kind of showing something about my vintage. Look, I think I'd say 2 other things. I want to say 3 more things. The first is a kind of summary of this, and this is a calculation very much like the calculation that Jason had presented some years ago on behalf of the Council of Economic Advisors. If you say to yourself, based on our results, suppose productivity growth had been since 1973 as it is now, how much higher would wages be? Answer, depending on just what you look at, about 65%. If you say, suppose none of the stuff that happened with mean median had happened, that would have been worth 30%. And if you say none of the stuff that happened with respect to the labor share had happened, that would have added an extra 5%. And that's basically a summary of the conclusion that the linkage view is the larger story here for understanding why wage growth has slowed relative to other parts of the story. And so our conclusion from a policy perspective is only modestly useful. It is that success in increasing productivity growth is likely to translate into wage growth. Now, one clever reporter in conversation with me thought he had an effective gotcha by saying, doesn't that mean that the Republicans are right that their corporate tax increase will substantially raise wages? And my answer was absolutely not, that the syllogism that said that corporate tax increases would substantially raise wages was a syllogism that said, A, it would substantially raise the level of the capital stock, B, that substantial increase in the capital stock would be enough to substantially raise productivity growth, and C, that substantial increase in productivity growth would translate into higher wages. And yes, the C part of the syllogism was correct, but no matter how correct the C part of the syllogism was, it didn't vindicate the A and the B parts of the syllogism being errant nonsense. If we had more, this would be a more encouraging finding if we had more convincing ways of arguing for policies that would increase productivity growth. But it certainly suggests that the traditional view that that's a hugely important thing to do is vindicated by our results. At the same time, and somewhat surprisingly, once I realized the logic here, our results suggest more skepticism than I previously had about technology-based theories for rising inequality, by suggesting that the extent of the trends towards rising inequality as manifest either in the capital labor share or the mean median ratio seem to be largely independent of the pace of technological change as reflected in productivity growth. Let me just conclude by reflecting on the monopoly power dynamism hypothesis. And I'd make these remarks. One, since I've been impressed by the gap between the rate of profit and the real interest rate, and the gap between the rate of profit and the low rate of investment, this is not an uncongenial theory from my point of view. Two, it's a theory that is broadly consistent with our findings in the broadest level. If somehow there's been a general trend away from competitiveness that hasn't particularly, in a 5-year interval business, risen or fallen with the rate of productivity, but has been having effects on inequality, it might well justify a pattern of the kind that we see. So it's a view that is potentially compatible with the views that we're expressing here. But three, I'm not sure that it fits the facts ideally. It is a much more compelling, it would be a much more compelling explanation of a rise. It would be a much more compelling explanation of a falling labor share because there are more monopoly profits than it is a compelling explanation of a change in the mean a change in relative wages between mean wages and median wages. And yet, as this comparison suggests, and as Jason said in his presentation, most of the action is in relative wages of different groups, is in relative wages rather than in the capital share, and more monopoly profits would be expected to show up primarily in the capital share. That's, I think, the first difficulty. Second difficulty is that I think the business about inequality between firms versus inequality within firms is fundamentally unconvincing. I have followed Harvard University as an institution over the last 30 years reasonably closely. 30 years ago, Harvard University employed almost everybody who worked in a dining room, whereas today it employs only half the people who work in dining rooms. Harvard University employed almost everybody who worked on the lawn, whereas today it employs almost nobody who works on the lawn. Harvard University employed almost everybody who made hundreds of thousands of dollars or millions of dollars managing its money, whereas today it has substantially outsourced that function. And so a general tendency towards outsourcing and decentralization would be expected to produce more wage inequality across firms without having anything to do with concentration or monopoly power. And I would say the other evidence, the direct evidence that there is more monopoly power, I don't find terribly convincing. Yes, the FTC doesn't enforce against mergers between company number 7 and company number 6 in an industry as much as it used to. But presumably the really serious mergers are between number 3 and number 2. And it was enforcing about as much or more as those. And most of the changes in concentration are not due to mergers. They're due to the organic growth of some firms. Who exactly is bearing the brunt of the monopoly power associated with Facebook or Google? I guess maybe it translates into higher advertising prices for some businesses that as an intermediate product are buying advertising. And that's probably relevant for some purposes, but every time I use Google, I pay $0. And so as a consumer good translating into profits, I'm not sure how convincing that is. And for reasons we could discuss in some detail on another occasion, the hypothesis that Delta Airlines and American Airlines are colluding because Vanguard owns stock in both of them doesn't seem to me a hypothesis that survives much contact with the people who are involved in running those companies. So I'm sort of could believe it, would kind of like to believe that the evidence is stronger, think that it fits our story, but think that the basic facts that we're mostly talking about within wage inequality, and that the evidence on why there should be this big increase in monopoly power directly is not so compelling, leads me to a certain ambivalence about that category of theory as an explanation. Thank you.
Good afternoon, and thank you, Adam and Jeremy and Peterson Institute for inviting us to join the discussion. I think many of you know that productivity is and has always been at the core of McKinsey Global Institute's research agenda, and it is really refreshing and important to ask not just what's causing the current productivity slowdown, but also what the consequences are. And I think the two papers that we just heard about, both of them took some of the most intriguing patterns we see in the aggregate economic data today. Anna and Larry's paper looks at the diverging trends in productivity growth and wages and unpack some of the causes behind that. And I think they provide quite compelling evidence on the fact that we haven't seen the delinking, that it is more of the other orthogonal factors that have contributed significantly to the differences in the two patterns. And this is broadly consistent with what we have found when we have looked at the wage share contributions wage share decline contributions from different sectors. When you look at the decline in wage share in GDP in the US since 1970s, of the 5% drop, full two-thirds, a striking two-thirds, come from a single industry, manufacturing. And half of that contribution is due to the fact that wage share in manufacturing itself has declined. The other half comes, roughly half, a little bit more than half, comes from the fact that manufacturing's share in the overall economy has declined, and manufacturing started with a higher wage share than the rest of the economy. And when you think of the manufacturing industry, we don't really find a single obvious answer for why this has happened. Many of the orthogonal factors that Anna and Larry mentioned in their paper, they actually are arguably strongest in the manufacturing sector, whether it's declining unionization, automation, offshoring, outsourcing of non-core activities, the Harvard example that Larry just mentioned. All of those have played a role in the manufacturing industry and suggest there is many more smoking guns that we would look for the reasons of the divergence than just the delinking or delinking between productivity growth and wage growth. That said, I think I would be curious to see what you would find if you would run the regressions just on the manufacturing sector, particularly on the case of the technology, given that that is where a lot of that is happening. So in this discussion, your focus has been, and I think a lot of the focus has been on the fact that productivity growth has not translated into wage increases. I think one thing we have started to ask ourselves is that if we should actually flip that question and say, could there be some feedback mechanisms in which way the low growth in median wages is actually feeding back to helping reduce productivity growth? And on our industry work, we see two potential avenues for that. The one is quite direct. Low growth in wages actually reduces the incentives to invest on labor-saving technologies. And when you think about, for example, the second contributor in the US has been retail, where this largely has come from the within industry declining share on wages. We actually do see a difference in the adoption of retail cashier automated technologies between Western Europe and US, for example. So that's the first argument. The second one is actually taking it beyond to broader implications from demand from the low wage growth. So you have to think that it's a fair question to ask that how far to the future do you need to project some of these trends and the divergence before many companies will start to ask, as Henry Ford did, should they pay more for their wages in order for them to be able to afford their goods and services so that actually they can continue to see their demand grow. So turning to Jason's paper, where the core argument is that is the rising business concentration the common cause behind rising inequality and slowing productivity growth? I think this is, again, one of the very timely questions, given that the corporate concentration is one of the big trends that we see, but we don't necessarily understand what the causes or the consequences are. And in our work, the fact that we are seeing corporate profit concentration rise much faster than revenue concentration actually does lend to support to Jason's first argument that there is a relationship between the business concentration and rising income inequality. However, on the second one, on the question of whether rising concentration has led to lower competition and thus contributing to the lower productivity growth, in our forthcoming report where we look at the reasons behind the recent productivity slowdown in the US and Western Europe, we actually don't find evidence that this has been the case, that we would see lower competitive intensity actually explain the productivity growth at the sector level. We looked at this in 6 specific sectors. I won't go through all of them in the interest of time, but I'm happy to come back to them if you are interested. But let me highlight 3 examples. The first one would be automotive. On the OEM or the original equipment maker side, that has tended to be relatively concentrated on the last few decades. Yet the competitive intensity and the race to produce high-quality cars at lower cost remains very high. And we see 3 reasons for that. First one is that over the last 10 years, the highest rising concentration has really been on the parts industry, where you have seen the global number of suppliers drop from something around 30,000 to less than 5,000. And at the same time, the top 100 automotive suppliers, the revenue share has risen from 17% in 2004 to closer to 50% in 2014. Yet that parts concentration, if you want, has actually translated into faster productivity growth because of the fact that they have invested more on, or productivity improvements because they have invested in R&D as well as new platforms, etc. So this is an example where you can say that the consolidation actually helped increase the productivity on that segment. Second example, retail. This is an interesting industry where already in the 1990s we saw the rise of the large-scale modern formats be a major contributor to both the consolidation in the industry. You see the number of retailers decline, but at the same time also was a major factor in improving productivity as they were able to invest on the supply chain. And this translated to a real productivity acceleration that actually was so substantial that it showed in the aggregate numbers. And what we are seeing right now is another technology-enabled transformation where the entry of e-commerce or online trading is a potential for raising productivity pretty significantly. We estimate that just when you think comparing the poor play estimates, there is potential for 3 times higher labor productivity in the retail industry when you are doing it online versus on a store. This is a transformation that's really very early stage still. Only 10 cents out of every dollar spent in retail is spent on online, and Amazon is not all of that. It includes a lot of other online as well. And I think there's a real race between both the pure play online retailers like Amazon before their Whole Foods acquisition, as well as the more incumbent brick and mortars, to find the right Goldilocks balance between the stores and online operations. So I think the competitive intensity here really is coming from the transformation and who is going to win the next waves, rather than whatever is going to happen to the consolidation. Third example, then, tourism. And we are looking at, I'll give you an example of one of the subsegments we looked at, which is hotels, which is clearly an industry where we have seen the large-scale corporate hotels consolidate, Marriott and Starwood being a good example. A lot of that consolidation has been motivated not just by the usual cost savings, but also the capacity to invest on digital technologies, whether on the front line in terms of automated check-ins, etc., but also on the back office on the data. And I suspect that a lot of the changes that are happening in a tech-enabled new players, both at the resale of hospital beds, think of Booking.com, etc., as well as, of course, the Airbnb platform that has allowed a large volume of new beds to come, very small-scale beds to come on the market, has, despite the consolidation at that one segment, really creates a lot of performance pressure and productivity improvement incentives for all the players in the field. So I won't talk about the others, but overall, we don't see that the consolidation provides enough evidence at our sector cases for the fact that it would actually explain some of the productivity growth slowdown that we have seen in these sectors. And actually, we find plenty of other reasons for explaining that, so you don't need to assume that that's the case. So overall, just to conclude, I think both of these papers provide shed light into very important trends we are seeing in the aggregate economy, and I think help us understand them better. But I think our job is far from done, particularly as we see the digital transformations go through a broad base of the economy. We as economists overall have a long way to go to understand what's happening at the productivity dynamics and how they translate into some of the aggregate trends. And we certainly hope very much to be part of that debate by contributing our research and being part of the debate. And we'll hope, Adam, that you'll continue to convene us so that we can collectively raise our understanding of productivity growth in the digital age. Thank you.
Okay, that was great. Many questions were asked, and many answers were given, but this is going to be even greater now. Can I ask before we get started? I believe Lawrence Michel or Josh Bevins are in the audience. Yes. Okay, there you are. So basically, what I want to do is I want give you guys a chance to react. And while you're gathering your thoughts, you'll have some time. I'm going to give Jason a chance to react, since he had two discussants, but not before piling on myself. And so I'm going to ask you a question, Jason, which you can feel free to ignore it and just answer Larry or Jana. And so my question to Jason is: couldn't all this phenomenon of rising margins, greater market power just be the fault of the Democrats? Because, there's all this regulation that they came up with in various administrations, particularly the one that you were involved with, which reduced business dynamism, as you convincingly laid out. And so, less entry and exit, meaning, less competitive pressure.
Great. This is slightly unfair because Larry and Josh have been thinking about their answer for about 15 years now. And I was only for 15 minutes, and I was also planning to make a joke about my two discussants, and you stole that. Thanking my two discussants for their comments. So I guess I just want to step back and clarify a little bit. I think there's good concentration and bad concentration, and the good concentration is what comes about organically from innovation, and the bad concentration is what comes about because of barriers to entry, whether those are stupid regulations Democrats did, or changes in antitrust practices. And my argument is maybe it's a syllogism, is that the bad competition is bad. And second of all, that any policy that we have isn't about making everything smaller, it's about addressing the bad competition. And so maybe that will have a small effect if you think the bad competition is a small fraction of it. Maybe it will have a large effect if you think the bad competition is a large effect. But it's not, but it's not going to be counterproductive. I think part of what I was trying to contribute in the argument was an explanation of mean-median inequality or inequality within labor income, not just the labor share. Absolutely, the traditional argument for monopolies is that it's going to change the labor share, and there's Autor et al. Have evidence for that in industries where you've seen increased competition. Increased concentration, you've seen the labor share fall. But the whole point of the inter-industry wage differential story, and it may, you may be convinced or not convinced, but the whole point of that story was to form a link between concentration and dispersion within wages, where some people are being paid higher wages and others lower wages, not just with profits. And a key part of that story is a rent sharing part of that story, where rents go up and rents are partly shared with workers. That gets a little bit to the bearing the brunt question, which is the argument here isn't that Google is going out and lowering anyone's wages or making anyone worse off. It's that Google is paying everyone that works there even more. Other firms aren't, and that's helping to explain some of this divergence. Some of the other points, consolidation has been an important part of airlines, hospitals, and telecom, to just name, three sectors that are a decent fraction of the U.S. economy. When Facebook buys Instagram or WhatsApp, or Google buys some minuscule company we haven't heard of and will never hear of because it's then going to become part of Google, how do we think about those in terms of concentration? And then, yes, of course, outsourcing is a part of the story. But if you look at things like the link between concentration and labor share, I think that suggests that it's something more than just outsourcing going on there. And then on Jenna's comment, I thought that was interesting, and I really look forward to the study and want to see it. The question I would have, though, is to what degree does a few micro examples add up to the macro evidence? And so some of the examples you had were actually industries that were raising their productivity or increasing their investment and overall in the economy. We haven't seen that. Again, I haven't looked at it. And so I'm sure there'd be different stories going on in different industries at different time periods. But the question is what's going on in aggregate. Thanks. Oh, in answer to your question, yeah, no, I think there's all sorts of dumb regulations that Democrats and Republicans have done, and I think especially at the state and local level, there's quite a lot that make it too hard to start a business, too hard to move between businesses, and we'd benefit from reducing this.
But more seriously, do you think, I didn't see you really pushing the story that the lack of business dynamism might be causal for, increases in market power. Do you think that's a reasonable story to push or not?
I think there are some barriers to dynamism, and they thus increase market power. And then once you have market power, you can buy people before they come in and do other things to further entrench and keep that position.
Okay, who of the yes, go ahead, please. Introduce yourself.
Well, thank you very much. I'm Larry Michelle. My colleague Josh Bivens may add a few words. And first, I want to appreciate the chance to say something, and I welcome the research from Anna and Larry to engage us and use our data, and I think that pushes us toward a better understanding of how we understand our world. And I think ultimately there's much less difference between us than what you would get from the presentation or the paper. So let me go over that. First, there's no basic difference of fact that since 1973, net productivity rose 73% and typical workers' wage and benefits rose around 12%. So from that 60,000-foot level, it's hard to deny that typical workers didn't gain that much of the total growth in productivity. So there's no disagreement about that. The second thing is okay, how do we interpret that? I take the paper as sticking up for the honor of productivity. It really wants to say productivity raised pay, but all this other bad stuff happened at the same time, and leave productivity alone, look at the bad stuff. And what we say is that productivity provides the potential to raise pay if you actually had policies that prevented the rise of inequality so that people's wages could rise. So to me, that's a matter of spin, interpretation. I could have written these results up as a point of agreement. I salute productivity. I always say I would take my union card as an economist. If I didn't, there's no policy differences between us in terms of should we pursue public investments and other things that are going to raise productivity? None. Okay, third point, what do the actual results show? Again, I think I could have written the paper talking about the glass half full. They wrote it about the glass mostly full, So the original graph was developed in response to a wave of thought coming from Brookings Institution in the early 90s and all, that the problem of wage stagnation was really the productivity slowdown, because from Brookings, everything that was wrong was due to the productivity slowdown. I thought that showing that there was rising productivity but median wages were stagnant was kind of like a useful thing to say, no, that's not really a full story. So, okay, so what do the results show? To me, raised on the productivity and pay are going to have a one-to-one relationship. I think there's a lot of evidence in the paper that it's not one-to-one, and you could have emphasized that, especially when it comes to a typical worker, right? That which is the big issue. So I think the results with production workers where it's around a 60% contribution. You could write, oh, well, we find some linkage, but it's not the total linkage that we expect. Okay, last, and we have a little paper we're going to give out. It shows a few other, we tinkered with the data in two ways. We don't think you should specify unemployment as just changes in unemployment. I mean, the late 1990s was important for raising wages, not because there were changes of unemployment, but that there was persistent low unemployment. It's about the unemployment level. So we added the unemployment level to the regression, which shows less linkage. And also very similar to what you did for the early period, we took out the whole period of the late 1990s and said, what's the linkage between 1973 and now, if you don't look at the late 90s? And the answer was 0.3, as statistically not significant than 0. So I would just say, I don't think we should push too hard on the specific point estimates. They really show a glass half full. And we should all rally to raise productivity and eliminate the growth of inequality. Thank you.
Great, thanks. So let me give Anna and Larry a chance to react.
Look, I think we probably are not that far apart. I certainly wouldn't want to suppose that the only thing that determines the level of wages is productivity growth, and there's a lot else that determines the level of wages, and I think we were quite clear in saying that, and I think we were quite clear in saying that it was important to identify those other factors and to work on those other factors. I think there is some suggestion that is around a fair amount that productivity growth doesn't translate into wages and might even be counterproductive because capital's displacing labor and reducing opportunities for labor. And I think it's useful to do the kind of look that we do between periods of different productivity growth and see that that's not true. I agree with you that the coefficients are not all one, though in a fairly substantial number of cases you can't reject the hypothesis that they are. You can't reject the hypothesis given the uncertainty with which they're estimated that they're one, and to the extent that we don't measure productivity on the right-hand side completely accurately, they are likely to be biased downwards. And that provides an additional reason for taking their quite clearly different from zero level and suggesting, as we do, that there's linkage. So I guess I prefer our balanced view of these results to your balanced view of these results, and that's probably inevitable. And I think you were probably writing in reaction to an overly simplified view that sort of existed in the air at a certain point in the 1990s, and I think we were writing in reaction to a perhaps overly simplified view that people had taken from your work, whether it was exactly the view that you had taken or not. It's always going to be true that if you take any time series regression and you take the period that has the biggest variation in X that drives Y and you remove it from the sample, the result will be attenuated. So your observation with respect to the 1990s doesn't do much for me. Anna just confirmed in a note what I thought, which is that while the results we report had changes, it was her recollection, and we'll have to compare notes on this afterwards, that doing it with the level of unemployment doesn't have a substantial impact on the results. I'd agree with you that I wouldn't want to hang my hat on any view that the change in unemployment was a better variable to use than the level of unemployment. And I think we can find agreement on the idea that we should pursue policies that are both pro-equity and pro-growth. And I guess I'd just say with respect to Jason that I think it would be useful to do some calculation and reflection. As Jason acknowledged, I was a major proponent of this generation's version of the rents as wage sharing, rents into wage sharing, rent sharing into higher wages theory. And it was never my idea that most of rents went to wages rather than a bit of rents went to wages. And it seems to me that to tell the kind of story you're telling, where there's relatively small effects on workers, on profit shares, and quite large effects on wage inequality, you really need a lot of rent sharing that follows a rather particular set of patterns that don't seem especially plausible to me. You know, let's think of an example. Suppose Fortune shined on the Peterson Institute, and somebody gave it an endowment gift that enabled its flow of annual spending to be increased by 50%. What would happen? I imagine fellows' salaries would be higher, but they wouldn't be 20% higher, and they certainly wouldn't be 50% higher, because they're set by the market. The main thing that would happen would be there'd be more money at the Peterson Institute, which will enable it to do more of what it does. And that would be how I think about monopoly power. So I'd want to trace through those links, and maybe the arithmetic works out differently than I think it does.
Great. So we are a little late, so I'm going to conduct 3 questions. Neil Merotra first. Just identify yourself again, please, and then we'll go to the line.
Neil Merotra, Brown University. So my question's primarily for Jason. If you could elaborate a little bit more on what can be done on the federal level about land use policies. And it seems like a lot of activity, a lot of economic growth is concentrated in cities today, but cities are not expanding in the way that they need to in terms of affordable housing, in terms of transportation. We've talked about how public infrastructure costs way too much relative to Europe and other countries. What are the levers that can be pulled on the federal level? And perhaps Larry has a view on this as well.
Thanks. Just a sec. We're going to collect just 2 more. Peter Fisher,
Thanks.
please identify yourself.
Peter Fisher, Dartmouth. Enjoyed all the papers, but some questions for Jason, really. I mean, some like Larry, some sympathies and some skepticisms. First, the antitrust textbook I had to pour through late at night had whole chapters on addressable market, which I assume have had to be completely rewritten for the current generation, and I think you'll want to think about that for some industries. Secondly, I think you'd want to drill further into fixed costs versus variable costs, oligopolies. The fixed cost oligopolies want to keep prices high. The variable cost ones want to drive them down, and that has differential effects on competition. And third, if you want to tell your story from dynamism to competition, I think a little more sympathy for the creative destruction argument, and then the fact that your death rate wasn't going down after a period of turmoil in the economy is something you'd have to drill a little further into. Love your comments on that, but food for thought.
Great. And Krishna, please.
Thank you. I'm Krishna Guha with Evercore. A couple of quick questions for Jason, one for Larry. For Jason, if you strip out the tech sector, which may have some unique characteristics, do you still find the same results for the rest of the economy? And linked to that question, one would normally interpret monopoly power as giving companies the ability to raise prices, and yet we're in an environment where it seems very difficult to get inflation up. So how do you square that circle? And then for Larry, it's more of a sort of forward-looking question. In the event that we were on the brink of a period where capital labor substitutability increased a lot with AI, robotics, and so forth, how would you expect that to affect these trends going forward?
Great. Maybe starting with Jason.
Sure. And then let me do one thing that wasn't an answer to one of the questions. I mean, I do think, and this gets to what Larry Summers said about Larry Michel, and I don't know that you do this, Larry Michel, but I certainly heard all the time if I was talking about a policy to promote productivity, like more R&D, and then I talked about wages, somebody would say to me, it's just going to be the same as the last 40 years. They're going to get more productivity. They're going to get more profits. There's no reason wages will go up. So there are a lot of people who have this mental model in which wages are being determined by one thing, some Marxist reservation, reserve army reservation wage. Profits are then determined by the residual between that and what you get out of your productivity, and your productivity thus doesn't translate into wages. So I think I have encountered an awful lot of people that have had that mental model, and I think it does affect the way they think about a lot of public policy questions. And so I think this paper is very useful in correcting that and finding, frankly, a higher frequency link between the two than I would have expected to be the case. I think we sort of know there's a very strong low frequency across large numbers of countries link, but I think the contribution here was that it was an even higher frequency than I would have thought. To answer some of the different questions, Neil, most of this obviously is local policies. The federal government can play a little bit of a role in bully pulpit, a little bit of a role in how we use some of our subsidies for things like public housing and making them maybe contingent on this. We found in the Obama administration there are a lot of mayors that actually wanted to do things, recognized this was a problem and didn't know quite what to do with it. And you give them a toolkit of here's 5 different things that you currently are doing that is restricting land use and reducing people's mobility. There are some things like housing vouchers. When you have a fixed value for a housing voucher, you're paying a larger fraction of the cost in a low-cost area than a high-cost area. And so we did an experiment with making them proportional to the cost, which would make it more neutral towards sort of more pro-mobility. On Krishna's question, I mean, the price is inflation. I guess I think of monopolies as being about relative prices and inflation being about the Fed and maybe not the money supply, but the overall macro environment. So I don't think, you wouldn't look at a country that had a really high inflation rate and say they had more monopolies, and a place that had a low inflation rate and say they have low monopolies. You certainly see this concentration and this dispersion of returns if you exclude the tech sector from your numbers as well. And in some cases, I think the story outside the tech sector may be even in some ways a little bit clearer because you see it more of a link between mergers and antitrust practices changing and hospitals than you do in the organic growth that we were talking about before in the tech sector. In terms of Peter, I guess that was a lot to, I guess I'd like to think about all of that more and not answer you now.
Larry.
Let me thank everybody for the very helpful comments. I guess, Krishna, if we saw a increase in productivity coming from capital that was highly substitutable with labor, one would expect to see an acceleration of productivity growth and a sharp reduction in the labor share at the same time. And I am a little bit less worried about that than I was before because of the discovery that past accelerations and decelerations in productivity growth had less of those effects than I would have expected. I don't regard that as dispositive with respect to the future, but I am a little bit surprised by what it was that we saw. I think Jason said it well. I do think the idea is a bit in the air that it's really not that productive to work on productivity growth because it all ends up going to people at the high end. So I do think that our demonstration that to a very important extent that's not true for the fluctuations we see is, I think, I do think is a useful thing to point out. I think the antitrust issues are really quite complicated and subtle, and I guess I just remind you of kind of an old antitrust idea that plenty of economic theorists have found exception to, but that at least I still find useful to think about, which is suppose you have an industry with firms A, B, C, and D, and firms C and D want to merge, and they say it's because they'll be more efficient, and other people say it's because it'll make the whole thing more of a monopoly. How can you tell? Well, one good way is to see what firms A and B think. If the new firm represents an increase in efficiency, then firms A and B will hate it. And if the new firm, if it's promoting monopoly power and a greater concentration, then firms A and B will really like it. And I think if you look at actual antitrust, almost always the competitors are enthusiastic about the government stopping the merger. And the notion that we have substantially too little antitrust and substantially too little enforcement seems to me a little less obvious in light of that fact. And, I'm not sure that I'm not for more antitrust. I'm just not sure. I mean, let me just do two examples that make the point. Is Amazon a terrible, bad monopoly, or is Amazon good competition for all kinds of local monopoly stores where there isn't much competition? That is, so far, Amazon hasn't raised the price to anybody of anything. Now, maybe there'll be some grand predatory price which will jack the price up in the future, but it hasn't happened in 20 years in books. And at this late date in the history of economic science, there are remarkably few examples of actual predatory pricing. Same thing's true in the dumping field, of a moment where somebody actually subsidized something, drove out competitors, and then charged a monopoly price. That is hugely feared, but there's very little actual evidence of actual evidence of it happening. So I would just be a little cautious on a little extra. And Jason got close to the position, a little extra gratuitous antitrust surely wouldn't be harmful. And I'm less certain of that proposition.
Jana, what about a little extra gratuitous antitrust?
A quick response to the question of what happens to the profit concentration trends if you take the tech industry away. Actually, looking at the S&P 500 since 1990, it is financial industry, health and pharma, as well as manufacturing that have increased their share from 17 to 50% in this, almost 50% in this period. So it is not just tech, it's clearly across the board. And I think just to clarify, I think we need to keep away from making the assumption that if profits raise, that must be bad for productivity. It is actually partly because productivity in these companies increases that profits increase. So I think we need to talk separately about the productivity trends and the profitability concentration trends.
Jason, any final urge to defend the honor of something, if not productivity?
Well, I'll just say
maybe-
very quickly, I think there's an entirely different conversation about the tech sector and the non-tech sector in terms of the role that antitrust enforcement has played and what the policy remedies are. In the tech sector, there's both a more compelling case that it was innovation that led to the scale and that network externalities are something we all benefit from. But there's also a scarier case that it's a much larger and more important part of our economy. And I think the case one worries about is less about Amazon and prices, because if Amazon raised its prices a lot, you would get somebody new you could buy it from the next day, and more the sort of when you get trapped into or benefit from an ecosystem, then you also get trapped into that ecosystem, and the ability for somebody new to come in that's offering, a combination of search and email and social networking and whatever else, to come in as a competitor to the large firms that are already there, I think is quite lower than it is if Amazon raises its prices. But again, I find it, I don't want to try to understate my uncertainty, especially on the tech side of it. I think it has both sides. The non-tech side, we need to be doing more hospital enforcement. I'm pretty certain about that.
Great. We've run over a little, so let me thank all the presenters and panelists and close the session.
Thank you all very much. And just a please distribute, please link to your own things. It's all welcome. We will start the next session 5 minutes late at 4:20. That is on the political effects of sustained low productivity growth with Daniel Dresner and Anna Greenberg. Please take your needed break now.